we're very intense. We don't pretend not to be intense. We can't handle people who like have their work and have their life and want balance. I just don't fucking care about balance. Being the type of person who can't get off the phone quickly is like kryptonite. If I can't have a 1-minute conversation with you, I will not pick up the phone when you call me. And if you're the type of person who it's like you call me at 1:58 and then you try to keep me on the phone at 2:01, I have a 2 o'clock. I always have a 2 o'clock. Every company in our portfolio that's done amazing had 1 year where you thought they were going to die. And a lot of companies in our portfolio have died when you thought they were going to be fund drivers.
First things first, Ali, I have heard from multiple sources that you are a great networker. Do you agree? And if so, what does that mean to you?
It sounds a little like too commercial to say like being a good networker, but I am pretty intentional about trying to meet, people who I think would be interesting or good to work with. And what does that mean? I mean, it means different things in different parts of my life and my career. When I was in college, I started the business. And as an undergrad, you have a very limited network. And so the way that I got to know people is I would do these research decks and research reports, actually with one of my colleagues and partners now, a guy named Brian Harwitt, who's on our team. And he and I were friends in college. And we basically cold email people in corp dev offices who are Cornell alumni, just sending them the research report and saying, hey, I wrote a report. I'm an undergrad. I wrote a report about your industry. Would love to hear what I got wrong. I only need 15 minutes of your time. And that was really useful because as an undergrad, usually you're like asking, hey, can I get career advice or can you give me a job? And alumni want to help, but like they don't, it's like a hard ask. Can you read my 10-page deck and give me notes on the deck is a very easy ask. And so I'd meet these people who had, a little bit more time than a venture capitalist would have, but were in really important roles. And then once I had built that network, I would cold email VCs and I'd like literally put their portfolio company in my research report and be like, oh, it's part of my report. And can you just talk to me for 10 minutes and tell me what I got wrong? And I'd say like 1 out of 5 people responded, but, we were careful about who we picked to talk to. And I think, we'd show them the report. It felt like we had done some work and cared about it. We were able to have an intelligent conversation. And then I'd say, hey, by the way, I know 2 or 3 companies that may want to buy your portfolio company. And they're like, whoa, like you're like a sophomore in college. How are you helping me with like corporate development? And it was just a differentiated enough conversation. And then I'd say, oh, well, gosh, I've now met 3 or 4 VCs who all invest in the same space. And it's a similar concept of like, if you can't get invited to a party, start one. So I'd invite the 2 of them to drinks and they would come because they wanted to meet each other. And like, they'd have to deal with me being there as like the tax on the conversation. And I'd get to know 2 or 3 of them. And then I get to know another. And then, the flywheel kind of builds. So that was how I got the flywheel to build initially. And then what I would do is I'd find all the people who I thought were compelling. And I'd go through their LinkedIn, which is sort of annoying because you can't download somebody's network. You can only look at their network 10 people at a time. Mm-hmm. But I was like 21, 22. I had like a lot of time and no hobbies and I could stay up late. And so I'd spend like 3 or 4 hours per person. And I'd basically find the 5 or 10 best people in their network and I'd write forwardable emails. And the forwardable email was useful because, if I wrote to somebody, hey, so-and-so, do you know any investors you could introduce me to? They're not going to do it. And it sucks to be on the receiving end of that email because like, let's imagine, you said, hey, Ali, can I, meet a prospective LP? I have to like think about which LPs you should want to meet. I then have to like volunteer them and like volunteer their time, which is sort of me making an ask of them. But if you said, hey, Ali, can you introduce me to so-and-so at, whatever endowment? I can just forward that email and say, I didn't suggest it. They just asked if they could connect with you. And then the hit rate's also higher because now they feel like it's no longer anonymous. And like you would know if, Arun at Howard Hughes Medical said, no, I'm not going to talk to you. So it ends up being a little bit more specific. And I would do that. And I figured that my network had to introduce me to, on average, more than one person to create a viral loop, just like a social network. So that's how you get like the flywheel. And then once you have the flywheel, what you realize is you have more inbound than outbound. And that's really dangerous because you don't want to let the outside world control how you're spending your time. And so I'm really careful today. And I work, with a partner of mine, Michael Ovitz, who is sort of famous for kind of figuring out how to get himself in the right rooms and with the right people. And he's coached me a lot on making sure that more than half of my time is spent with people that I reached out to as opposed to them reaching out to me. And so it's eliminating things like standing meetings. It's eliminating, and it's even just tactical stuff of how do you politely say that you can't meet with somebody when they're inbound? Because it's not, if I had all the time in the world, I'd meet with everybody. But if I meet with everybody who asks, then I'm not spending enough of my time being outbound to people. And I want to spend the time the way I want to spend it. It's like your most valuable resource. And so a lot of it is just, every Sunday, thinking of your time just like, capital and investing a 30-minute slot into a particular thing. And more recently, it's also, I used to do like 14 30-minute Zoom calls a day, and I'd have 14 really mediocre interactions with people. And, now I've worked really hard on having 4 or 5 meetings a day that are like an hour, hour and a half. And you end up getting stuff done with better people. And then if you're really only going to have 4 or 5 conversations in a day, you have to say no a lot. And that's a really hard thing to do because like I'm a nice guy and I want to see people, but those would be probably a lot of the factors of how I've gotten to know people I wanted to get to know.
Yeah, and oftentimes you end up having
and build real relationships with them, not just know them.
Yeah. And oftentimes you end up having to say no to people that you already know. It's not cold inbound, right? And that can be a little bit more tricky.
Yeah, I mean, and it's not only tricky, it's just, it sucks.
Yeah.
Because a lot of people are, friends, or you've gotten to know them over time. And so then the question is, luckily we have like 45 people at the firm, and one of those 45, other 44 would be a good person for them to know. So it's still a way for them to have a touch point with the firm. A lot of times it's just not right now. A lot of times it's, hey, let me give you a call. So I try to avoid everything being calendared. And when I'm in an Uber or when I'm on my way to the airport or when I'm waiting to board, I just call people and catch up with them for 2 or 3 minutes. There's a guy in my life who I'm close with, who is like kind of famous. So I don't know if I have permission to use his name, but he's amazing in that when he calls you, you can get off the phone in 1 to 2 minutes. And so I'll be on a conference call and he'll call me because he's a hard guy to get a hold of. And I'll say, hey guys, hold on a minute. And I can actually pick up his phone, get something done, knowing that I'll just be off in a minute. Being the type of person who can't get off the phone quickly is like kryptonite. If I can't have a 1-minute conversation with you, I will not pick up the phone when you call me. And if you're the type of person who it's like you call me at 1:58 and then you try to keep me on the phone at 2:01, I have a 2 o'clock. I always have a 2 o'clock. And so, we train people here, make sure you're off the phone before the top of the hour or they'll stop picking up your calls. And also, if you're trying to get a hold of somebody, call them near the end of the hour. It's when they're most likely to have finished their last meeting before their next one. And so like calling someone at like 1:52 or 1:56, is good, especially if you've trained them to know that I can get off with this person in 3 minutes.
It's a good reputation to have. How do you've talked a lot about generating those relationships. What have you learned about maintaining and nurturing, and specifically those where they become very genuine, right? Which those are the best and ideally the only ones you want to have.
Not the only. I mean, sometimes it's good to have a transactional and commercial relationship with somebody, but I think it's about sincerity and just both parties sort of knowing what they're getting themselves into. There are people that we don't have a lot in common, but we have shared interests and we're transactional and commercial, and that's great. There's even better is when you end up becoming social friends with somebody, and there's a guy I do a lot of business with named Glenn Chesser. And Glenn has become one of my best friends. There's another guy named Justin Ostroff who's become one of my best friends. Jesse Beirut at IA has become one of my best friends. And, it's the best thing in the world because then your whole world combines and it makes doing business fun. But a lot of those relationships took years of just knowing each other through work and being authentic. I'll give you a pet peeve of mine. When I meet somebody and they start telling me private things about their life in the first or second conversation, because you're actually very tempted to think, oh my God, we're close. They're telling me something, intimate. And then you realize they tell intimate stuff to everybody. So you actually have it's just noisy. You have no idea if you're close with them or not. And, they're just sort of social climbing. And there's actually sort of something nice about some level of privacy in the first conversation, because by the time you actually share something, it's a little bit more intimate. But I think it's just about being authentic and clear. And, if somebody's if you're only building a relationship because you're dangling maybe into the future, but there's no maybe there, it's a really good way to be medium term oriented. And then the last one, and I talked to some of the people on our team, is just have long feedback loops. Like you don't need something from somebody the first time you meet them. And a lot of it is just sort of farming these relationships and building some level of serious relationship before then deciding you're like-minded enough to get into business. And then the last one is you just want to be a social creditor and not a social debtor. And so, there's people, you're talking about them earlier, there's people in my life who have helped me way more than I've helped them. And I'm completely uncomfortable with that. Mm-hmm. And it happens sometimes, but it's so much easier to just give and give and give and give until, it works. With that though, there's nuance. So for example, let's imagine I make an introduction between two people. It's got to be equally good or a favor to both of them. I will very, very rarely make an introduction if I think I'm asking a favor from one people. So I'm reducing my social capital with them, and I'm increasing my social capital with somebody else. Sometimes I'll call them and I'll say, I need you to take this call. It's a favor. I owe you one. Like, you can do this to me at some point now. But what you really want is you want to connect like two people together where like you think that both of them are going to spark. So that way people don't feel like you're like taking from them too much.
I got my MBA, and you read a lot of cases, right? And my favorite one was this one about, Heidi Rosen. So she is now, I'm blanking on the VC, which is not good for my example, but she's moved a little bit. But there's a whole HBS case study that many MBAs read across different schools about how she was an expert, I'm going to use the term networker, but just relationship builder from the 80s, and she's still active. And a lot of the things you've mentioned, she was also doing, especially that, like making sure that you give, you don't take as much, and being very careful about who you introduce to each other, right? And try to have, make sure there's something for both of them. This is a topic I love. And then,
yeah. And sometimes, you meet somebody who's not at the same level of somebody else, but like people want to meet young people as long as they're exceptional. There's a kid named John Ainsley who I just think is off the charts. And the introductions I've made for him are people who are more senior than him, just age wise, and maybe have been doing investing longer, but he's just like a ridiculously talented kid. And so when I make an introduction, I'm like, you're going to thank me for knowing John, because you're going to talk to me and you're like, God, this kid's 25. Like, he's that good. And sometimes, you get that spark, and it's not always as obvious as like, oh, one CEO to the other CEO. It's just people want to meet talented people.
What does Michael Ovitz taught you about, navigating the world of, I guess, venture and credit with his experience in Hollywood?
I mean, Michael has experience obviously in media and in LA, but his experience also for a huge part of his career really has been in technology and investing. It's a hard question to answer because there's so many things. So I'm trying to rank order them. The first one is incredible amount of intention on who you're spending your time with, cutting top of funnel crazy quickly. So when something's not going somewhere, don't waste your time on it. Kind of like a ruthless point of view on meritocracy, and a complete change in terms of what great means. I mean, he's a guy like, where the people he spends his time with are usually the best in the world or in the top 3 in the world of what they do. And, so like he has this like challenge where he can't handle somebody who's not like a 0.001% person. And it's contagious. And you realize that you spend so much time with people that, are like meh. And so a lot of it is sort of that discipline. A lot of it's velocity. How do you get more to actually, just picking up the phone and calling people on the way somewhere, or in the car, or, at 7 a.m., like on your, way into the office. By the way, if someone's not willing to pick up your call at 7 a.m., they don't really need to talk to you. If they don't pick up your phone call on the weekend, like, they didn't really need to talk to you. And so my conscience is clear. I gave you the shot. I gave you the call. I talked to a guy last night at 10 p.m. who runs probably $100 billion of capital. If he's doing calls at 10 p.m. at night, you can too. And so, I mean, there's a million different things. Also, the other really sort of, God, there's so many management lessons. One is the type of user experience you have. Michael is very results oriented. And what that means is he doesn't micromanage a process, and he doesn't say, well, you need to do this thing and then that thing and then that thing. He'll basically give you this incredibly like audacious thing that needs to be achieved in a time frame that you think is like completely ridiculous. And if you can do it, he'll keep working with you. And if you can't, he writes you off. And so it actually just causes people to do things they didn't think they could do before. And he's completely uninterested in why it's hard. He's just like, you can either move to heaven and stars or you can't. And if you can't, there's no room in the world. And he would tell me, because I'd tell people like, hey, you need to do this, and I need you to work this many hours. Like, don't tell people how many hours you need to work. Just here's the thing that needs to be accomplished. Here's when it needs to be done by. And the people who accomplish it stay, and the people who don't accomplish it, maybe they got unlucky, but like it didn't work. And so we'll move on.
So I'm sure there's a story behind that in which you convince him to join you guys and then work together.
Yeah. Having him as a partner is incredible. In the beginning, I mean, we met through an individual who's one of my early investors, and Michael, time and time again, has worked with young managers in earlier parts of their career and helped kind of accelerate their career. Hopefully, people that would have eventually gotten there anyway. But gosh, I mean, working with him kind of does accelerate stuff. And I think a lot of it was just like sort of proactiveness. And he, the first time we spoke, he's like, well, let's just try talking on a daily basis and see if like a relationship builds momentum. And when somebody says let's talk on a daily basis, not everybody actually makes it a daily basis. And I would just call him every free minute that I had. Hey, Michael, we're just up to this today. Or like I'd get in the car. Hey, Michael, just giving you a heads up. And
it wasn't a standing meeting on the calendar.
No, it was just every day we would talk 2 or 3 times, to the point where I knew what he was doing every day. He knew what I was doing every day. And it just felt like we were working together. And, my response time was really quick. I bet you most people who have ever emailed with me know that they get a response from me within the day for sure. But if you're somebody who's actually a relationship of mine, I'd be shocked if you didn't hear from me for 2 or 3 hours. And I'd be shocked if you didn't hear from me every 30 minutes or within 30 minutes, 75% of the time, because I'm just incredibly quick. And I think he values that too, because you just need to be, it's a high velocity business. And, the other things that I think we really related on is we don't believe in work-life balance. I don't have any hobbies. I have my family and I have this. I'm not interested in hobbies. This is like the most fun thing in the world. We're very intense. We don't pretend not to be intense. We can't handle people who like have their work and have their life and want balance. Like I just don't fucking care about balance, and I don't think he does either. And there is a level of intensity and velocity that we both cared about.
Do you remember your first meaningful experience with money?
Yeah.
How did it shape your interest in finance?
So I went to Cornell, and I found that a lot of kids at Cornell thought going into finance was like lame or wrong, or like capitalism was like stupid and like why would you care? And I found that almost every single one of those kids had never been afraid of not having money. They were like from these wealthy families, and the feeling somebody has from money that they're given versus money that's been earned is very different. And people who grow up very wealthy or wealthy at all often don't appreciate why would you want to have this, because it came to them so easy that it doesn't seem like worth it or earned. And so I thought that was interesting. I thought investing was interesting because money does matter to people. It's their savings. And when you invest someone's capital, the decisions you're making are really important. And I found that making important decisions was fulfilling because you feel like you have life purpose, And when you're investing in endowments capital or foundations capital or even an individual's capital, like they really trusted you. Like when somebody gives you their money to invest, that's like a really emotional moment, because they're like, yeah, like this is for my family. It's how I get by day to day. And I'm trusting you to keep it safe. And I like being trusted. I like building something that somebody can trust and being the type of person somebody can trust. And then the last thing is, capital really is an at-scale way to operate. And so what I mean by that is, if I go to a coffee shop and I buy a cup of coffee, it's a one-to-one relationship, and I'm happy I got coffee, and the barista's happy because they made a bit of money. If I give a talk in a class, but if I didn't show up at the coffee shop, is it a big deal? If I teach a class and there's like 50 people coming to the class, I kind of need to be there because I wasted 50 people's time if I don't show up, and so I'm going to be on time. That's a 1 to 50 relationship, not a 1-to-1 relationship. If I code an application, that's like a 1 to thousands relationship. And if I invest money into people who are coding applications or into companies, then you're basically expressing your point of view on the world in the most at-scale way that I know how to do it. And that is cool. And even within that, I realized that in terms of the parts of finance that I wanted to be in, I wanted to invest in things that weren't yet obvious. If you're at a hedge fund, and people are, and God bless them for it, like if you don't buy the security, somebody else will. If you're doing, something that you and I both do, which is early stage venture capital, if you don't invest in a company, the company might not exist. And you're going to have like an influence on the company and help them figure out what they need to do to achieve their next round of financing. And do you feel like you're bending the curve a bit more? In our credit business, we're often the first institutional capital that a fintech company is bringing on. If we didn't the way we work with them and the buy box that we give them and the underwriting manual we agree to and the types of products that we want to release and helping them figure out how to mature their capital base over time, it just feels like the thing that I did had more impact than going out and buying regular way ABS. If I don't buy a security, somebody else will buy it at a different price. And sure, there's like incremental capital efficiency that gets created, but it just feels more impactful when you're financing something where you still can have an influence on the outcome and it might not be obvious to much of the world.
So let's talk a bit about the company, right? And I actually, we have a portfolio company in common, that's Digit, and I talked to David to just get an inside look into how the experience had been working with you guys. And something that I thought was interesting is that Treville did the most amount of due diligence before even committing to a term sheet. So when the time came to actually commit, you were so informed that the process moved very quickly, right? So maybe does that resonate with how you are building the culture of the company, how you guys do things?
Yeah, I mean, I think there's a few parts to that. The first is, what is the product of the firm? We're trying to build an investing machine. And a lot of that is process. And, we have 3 strategies. We have a venture capital business. We have an asset-backed credit business, and which is what we invested in Digit through. And we have a capital solutions business. And each of those strategies invest differently because you have to be a risk-seeking individual to be in all investing, you have to be a risk-seeking individual, but the amount of risk you're taking varies. In venture capital, you have to be high risk-seeking. And the decisions probably shouldn't be consensus decisions. In credit, they probably should be consensus decisions because, in credit, you're known for your losers. In venture, you're known for your winners. And in capital solutions, it probably leans a little bit more towards credit, but you're taking a bit of a unique point of view and a lot of the view on the company. And, and we have process stuff, when we meet a company, if anyone's wondering what we're doing on the back end, if somebody on our team meets a company, they think it's an interesting business, they write a 1-pager and they send it around to the team and say, hey, is it worth us investing more time? That we are not stringing along a company for something that the IC is going to pass on for something that we already knew. Because that sucks as the founder to in the third meeting get passed on for something you said in the first meeting. And it also sucks as an investment professional to be wasting your time on something that had no chance. And then the IC will respond and say, hey, these are the things that we're curious about that I'd focus the second meeting on. And then that evolves into a 2-pager. And we have IC on Monday and Thursday because in a lot of big firms, investment committee is political, where, you write this 80-page memo and then you present it. And if the deal gets knocked down, you're pissed off at everybody, or even worse, you're politicking with people ahead of the investment committee meeting, trying to convince them to say yes before the meeting actually happens. So by going from the 1-pager to the 2-pager, and by the time there's a 2-pager, it's an executive summary with an appendix, or, so you basically are just writing all your notes down. It's a very iterative process so that there's no weird moment if we decide to knock it. And it's usually, as we found out, something that either was the thing that made us not want to do the deal or the straw that broke the camel's back, because there are 4 or 5 things that all together just kind of we lost momentum. And in venture, and then the memo comes together, and it's important that the memo comes together before we do the deal so that the memo isn't marketing material. It's actually what did I think? In venture, term sheets are sacred. And if you sign a term sheet, the deal is going to happen. In credit, sadly, that's not really true. We think it's basically true for our firm. But a lot of people in our competitors in credit will basically try to sign you up to a term sheet as soon as they kind of know about your business, because they want to get the no shop and they want to get everybody else out of the room, and then they do their diligence. And that's why there's so much retrading in credit. And, in venture, it's such a relationship oriented business. In credit, it's a little bit less that way. And so people care about the reputations a little bit less. And we think that's one of our competitive edges, is how much we care about our reputation. If you're a bad borrower, you did the wrong thing, or you're defaulting, we have to go get the money back. But anything in our control, we'll try to control it to keep that good reputation.
How are the venture and credit strategies related? Do they overlap a lot, or are they completely independent?
So they're separate investment management businesses. They're affiliates, but they have separate investment teams. A lot of people will come and be like, "Oh, we'll give you some equity if you do the debt or whatever." And we're like, we can't actually do that. They're independent processes, but the teams learn from each other. They're looking at similar markets, and I'll give you that venture learns one key thing from credit, and the other way around too. The venture team learns how to be rigorous. And if you talk to our venture professionals, they are usually higher conviction on the investments that we make than most people in venture capital are. A lot of people in venture capital, if you talk to them about their investments, it's good founder, good market, and they think of them as option calls. If you talk to the people on our team, they could like read you the riot act on why we think this company is going to work. And I was talking to a founder recently, actually, who just went through YC. He's got like all these term sheets, and he was giving his allocations around like away really quick. And I said, what are you looking for in your investors? Because it feels like you're just kind of giving allocations away as long as somebody has a good brand. And he was talking about brand and hiring and BD. And my push to him was I said, you should look for the investor who has the most conviction in your business. The reason is if somebody kind of likes your business, even if they know everybody in the world, they can't really help you because they can't explain to somebody why they invested. And what you want from your venture capitalist is somebody who invests in you and then is able to make your contrarian idea consensus by explaining it to the rest of the world. You know, we were talking about Patrick O'Shaughnessy earlier. His magic is that he can take a contrarian idea and make it consensus because people listen to him and they believe him. And that's what you really want as venture capitalist. How do you do that if you're not high conviction on the deal? And in credit, it's such a rigorous business. I mean, the closing docs are often 400, 500 pages, reading the loan service agreement, the purchase and sale agreement, the subordination agreements, the legal, everything. And the diligence process is insane. And you have so much data. In venture, maybe it's not all the way that because you do need to take more risk, but it creates conviction. What the credit team learns from venture is an ability to get to get product market fit right. Mm-hmm. So the way credit normally works, the way you make money in credit is you make a big loan, you know, because if you're charging whatever, 1 in 10, 1.5 in 15, whatever your fees might be in credit, if the company is making a 12%, 13%, 14% return, it doesn't change your carry that much. You know, the way people make money in credit, unfortunately, is scale. So you're looking for something that's already at scale. And the way most credit deals work is you get to $100 to $200 million and you suddenly notice that it's a lot easier to raise debt. And you hire, you know, a capital markets team and they pitch to all the 15 to 20 to 40 firms. They're all going to bid and they're going to all bid within 25, 50 basis points of each other. And it's a crowded market by then. In our credit business, what we're looking for is we're more willing to take origination risk so that we can take less credit risk. What I mean by that is we're looking for a company where we think that the type of loans they're originating are super obvious to us, where we don't think there's a lot of risk in the loans. And also because there's not a lot of competition yet, because the company hasn't already put out $100, $200 million, we can structure the loan, you know, a little bit more favorably to us. We're charging a little bit more. We are able to get covenants that protect us. We're senior in the capital structure. We don't need to be mezz financing until later on. And so we're able to do things in a less crowded space where the credit is less risky. But what are we risking? We're risking our time. Because if the company can't make any loans, then like we wasted all this time on diligence. And so we actually have to be good as a credit team at predicting, does this company have product market fit? So that even though they only have $10 to $15 million loans out now, or even zero, we think that they have a good chance of $100 million. And almost no other credit fund will tell you they're good at underwriting product market fit. And we want to be just as good as all those firms at credit, but you need an edge and a differentiator. And often that's our edge and differentiator. And we have a lot of respect when we look at a credit deal of what's special about the company making the loans. You know, most people in asset-backed credit, they are just, they care about the assets and they look at the loan tape and they look at the loss rate and they look at the loan loss coverage ratio and they're, you know, measuring near loss rates to some base case, you know, that they're, you know, from some other comp in the market, like a small business loan comp or a consumer loan comp or whatever. And it's just a pure asset-oriented focus. We are underwriting those assets too, but we're also underwriting like, what is the story that matches the data? Why is this company able to originate loans like that? What about their underwriting is different? What about their originations is different? And everybody does it a little. I would argue though, you know, if there's a pie chart of what our underwrite is, more of our pie chart than normal is on the actual company itself making the loans. Not because we're making a loan, not because we're trying to take corporate credit risk, but we're trying to explain why is this company likely to make good loans for a long time in a market that we think will be really big.
Speaking of long time, assuming you do not make an equity investment through Crossbeam, let's say it's only a credit facility, what length of a relationship are you underwriting? Are you factoring in the fact that maybe at one point they will graduate out of your 50 then $100 million facility? Mm-hmm. Or do you want to bid them for a long time?
In the perfect world, we finance them forever. And, you know, we'll lend them with some level of covenants and rate. But if they prove to us that they've matured and they're safer, you know, we'll give them a lower cost of funds over time. And we have different pools of capital, you know, in our firm that, you know, takes different risk profile or, you know, can put leverage or not put leverage on deals. And, sometimes you're in the deal as the senior, but as they get more mature, you're willing to flip into the mezz to, allow the company to take a lower cost of capital from you over time. And, and that's great when we can stay with them forever. Sometimes, a company is pushed by their equity investors to widen the credit box to a point where we're uncomfortable or grow at a pace that we're uncomfortable, where, we do say we're not the right lender for you anymore. And we could be wrong. We're not going to try to do anything herky jerky to mess up your business, but we'll let you know. And, maybe it's time for us to get refinanced. And sometimes the market's just willing to offer capital that we think is at too low of an interest rate relative to the risk. And, thank God markets are not perfectly efficient or we wouldn't have a job.
At what point in the duration of the company did you start to believe yourself and think that this could be something much bigger than just a company out of a college dorm?
I think a lot of founders, especially founders who have done an unsuccessful business and then a successful business, they notice the difference of when you have product market fit and everybody wants to talk to you, and they it doesn't feel like you're pushing a rock uphill all the time. Suddenly you're getting pulled into more conversation than you have to ask people to stop being inbound so that you can be more outbound. And I'd say pretty quickly I realized when we were I was doing tiny little venture investments, I wanted to be a venture capitalist, but I didn't have the credibility at the time or the track record at the time to really earn my way into a lot of the best rooms. And then when I did, I started making credit investments. Suddenly, all these people that I'd always wanted to meet wanted to talk to me. The Bill Trenchers at First Round or Mickey Malkus at Ribbit, or all these people that I were my heroes. They were down to meet, and I was what? You want to talk to me? And I was 24, 25, and I thought, oh my gosh, this is the coolest thing ever. So it was pretty obvious. And eventually, luckily, because of the credit business, we built the credibility to build a venture business, and that took 8 years before we had that credibility. But it's gonna be an unfulfilling answer because I don't know how people take something away from this, but it was sort of, you just know it when you know it.
How about your role as a company leader? See from your point of view how it has evolved, from then to what it is today.
I still do deals, so I still like being an investor. But what the main thing is, I'm working as much on the investing machine and how we think about investing, how we think about risk, and when a company, in venture, the hard part about venture is figuring out what are the things that we need to believe. Figuring out what do I need to believe about this company to make an investment. And, for anyone who's done venture investing or done investing at all, you'll probably relate to this, where a founder tells you a bunch of things you believe. And in any company, there's 15 to 20 things. You need to believe in the management team. You need to believe in the market. You need to believe in the CAC and the LTV and the competitive matrix and the go-to-market mechanic and whatever. Each company is a bit different. And if you believe all 15 things with 90% certainty, so you don't disagree with the founder on anything, 0.9 to the 15th power is a really low number. You can't make that investment. And so a lot of what investing is not just believing things with 90% certainty. It's figuring out what are the 15 things that I need to believe about this company and getting to almost inevitable about 12 of them or 13, and then feeling there's 2 things that we just don't know. Because that's something that you can invest behind. And really building that muscle of being able to vocalize, these are the things these are the bets that I'm taking on your business. And when we pass, sometimes we say we believe you, just not as much as you believe yourself. We're at 80% on this and you're at 95. And so we don't disagree. It's just we don't have as much conviction as you do.
Yeah. That makes a lot of sense. And when you think of kind of some of the biggest failures you had, and maybe you don't call them failures, maybe they're just mistakes, but lessons that have been very important for how to inform you and how to build the company. Any one or two come to mind?
Tons. Sometimes you size a position the wrong way. And, we've gotten excited about a thesis and, but we were wrong. And, if we had sized it one way, it would have been better than if we sized it another. And, doing that was probably how we avoided losing money on crypto when crypto would go through its bubbles. And, we made some investments and we're still fine. We'd still make investments in the crypto space, but there was a time where there's too much exuberance and, we just decided we're not going to make more than 5% of our fund crypto related because we think it's an exciting market. We want to be in it, but we don't want it to blow a hole in the side of our fund if it doesn't work. And, we got to 2.5% of, the fund, and that was crypto. And I don't think those deals will do very well, or they're at risk at least. And that's okay. Like, that's how venture works. And so, you make mistakes on sizing before you make, new mistakes, and you try to avoid the mistake again. You make hiring mistakes. I mean, and founders could relate to this. When you're a founder, you've often never done the job before, and you hire your first VP of sales. You might not even know what you're looking for in your first VP of sales. And so, it's a lot easier to get firing right than hiring right. And so it's okay if you have to go through 2, 3, 4 iterations of the same role, because every time you hire the wrong person, you'll learn about what you're looking for, and then you hire the right person. And then it's like, it fits, it snaps into place. So I made some, and anybody does that. You also learn that the best thing in the world to do is hire young people that can grow organically within the organization. But learning when you need to bring in a senior, and what happens is my experience, and a lot of people's experience, and as a founder, is you hire a bunch of senior people who have great resumes because you assume that they must know what they're doing, even if you don't. Then you realize that they just have they don't really know what they're doing, and there's negative selection bias in hiring senior people, and there's cultural issues, and they might not be like-minded. So then you're like, no, I'm never doing that again. So you only hire young people, and you try to grow them over time, and then you realize there's limitations because they don't know how to do the job, and you can't fully grow them yourself. And so then you realize there's a mix, and you got to figure out that right mix that's right for your company. But there's all kinds. And some mistakes or failures, aren't in your control. As an early stage investor, the most frustrating thing in the world is when you invest early in a company and you get the founder right, you get the market right, the company right. But companies do run out of TAM eventually. And what happens is they raise the Series A at a $60 million, $100 million valuation, whatever, because they're all expensive now. And you assume the company's going to be worth $1 billion. And then they raise the Series B at like a $300 million valuation. So you assume the company's going to be worth $1.5 billion. And then you raise like the Series C at an $800 million valuation. So now the company has to be worth $2.4 billion. But eventually, somebody's going to get it wrong. Somebody's going to get TAM wrong. And, the good companies say, we raised it too high a valuation. We're not going to force this to be anything more than it is. We're not, and rookie founders, what they'll do, or first-time founders, not even rookies, they'll say our growth is slowing. We should hire more people. We should do product extension. They're forcing a TAM that doesn't exist because they raised an evaluation and expectation that cannot be met. And as a little early stage investor, you're looking helplessly because you're watching your perfectly fine investment go to shit because they're forcing something that just isn't there because some dumbass growth investor just priced it the wrong way. And, and then you have to do like a pay to play. It was they recapitalize it. You got to change the culture. And some companies survive that and some don't. And we've had things go both ways. And, that's an example of a failure where you have a company that you thought was going to be a fun driver. And, and that's why people say things like it only matters when you have DPI, and realized gains are more important than unrealized gains. And I'd say every company in our portfolio that's done amazing had 1 year where you thought they were going to die. And a lot of companies in our portfolio have died when you thought they were going to be fun drivers.
What kind of relationship do you aspire to have with founders in your portfolio?
We've always called ourselves founder fair. And there was this term founder friendly, which I thought basically became, we're going to agree with whatever the founder says because we're nervous that they're going to like us or not like us or whatever. And we just want a commercial, honest, fair relationship. We don't retrade. We say what's on our mind. We are humble about the fact that what is on our mind may not be right. So we want to debate and we want to litigate things. We are a shareholder, so we expect to be treated like a partner. And if we're ignored or not treated like a partner, that's a bummer. As an investor, we think the founders are partners, so we want to treat them like they're our partner. We want to help them. We want to work hard. We want to be responsive. So, but we're incredibly honest about what the relationship is. We have a commercial relationship as their business partner to do things in our collective best interest. And I think a lot of people fake these friendships. A lot of it kind of grosses me out. Where investors will become pretend like they're close with the founders. No, the founder's just doing well and you're sucking up to them because if this company wasn't doing well in your portfolio, would you be as close with them? It's no, probably not. You're social climbing off of their back. Your relationship and your reputation is based on them doing all this hard work that's making you look more special. And there's a lot of inauthenticity masqueraded as, compliment, whatever. The venture business is incredibly inauthentic to me and it grosses me out.
Staying a little bit on the, just getting a look through of inside the company, do you think there are any peculiarities, something about your culture that you think is unique, something that you guys do that will surprise people from the outside?
I think the level of intensity that they get from us. If you are a intense person who is like maniacal and high velocity, we are going to get along crazy well because you're going to be like, finally, someone who gets me. And if you're like a founder, because, or if you're not like that, we're not like, it's not going to be a match made in heaven.
Well, most great founders have that intensity as well.
Yeah. So hopefully our
Yeah.
culture has product market fit.
And before we run out of time, Ali, when you think of kind of the industry and your role in it, where do you see Treville going forward?
I think we're unique in that we have more than one asset class that we invest in. And, when people think about us, everyone has their biggest strength and biggest weakness. And I think that might be ours. Because when you're a shop that only does one thing, you're thought of as a specialist. And it's actually kind of what people want to see. But I don't know how to run a firm effectively only doing one thing. Because if your market is in a bubble, you don't know it. And even if you know it, it's really hard to stop doing investing. Like if you thought your market sucked for 2 years, what do? You just like tell everyone to go home and come back in 2 years. So what do people do? They just invest through the bubble and they try to have the best relative returns and, hope not to blow up. But when you're in 3 different markets, you can see the relative value in the 3 different markets. And to us, I think it brings a sobriety to the different types of investing we do. And I think we try to be like an investor's investor, just a lot of intellectual honesty when we approach a deal and being able to explain our thesis. And so what we want our role to be with the company is the investor who comes with the most conviction and the strongest thesis about the company that we're invested in that can help guide everybody, like what will make this company more valuable. Where will we go? We have 3 franchises and we want them to be some of the greatest franchises in the world. Like we want to be known as some of the best investors of all time. I hear people, and especially in the venture market, like, well, what are you trying to do? And they'll say 3x net. And I'm like, because that's like what you're supposed to rate, do if you're a venture fund. I'm like, fuck that. We're trying to get the high, like we want to be one of those iconic firms that had like 100x return. And those are the people that I look up to. Those, and that's what we want to become. And so we care about, and then also, in any generation, there's different asset classes that could build in different types of investing. And there's so many things that are different about the market that we're in today that didn't exist in the 90s or early 2000s or the 2010s, whether it's companies staying private longer, whether it's the half-life of S&P 500 companies, turning over more quickly. Like if you look at the amount of time companies in the S&P 500, it's like a much more compressed period than forever. Yet everybody wants long-term compounders and there's less of them. Like, what does that tell you? Have you changed your strategy because of that? There's new business types that exist today. And so we're always trying, like what we want to be is when something about the world changes, something about our investment thesis changes, what asset classes we care about, how we approach things, how we structure securities, what our theses look like in companies. So, we want to be on the bleeding edge of how investing is supposed to work based on the market that we're in.
Ali, you're clearly very passionate, but also knowledgeable about our market, right? How do you get this? Is it through reading a lot? Is it through talking to the best people? Is there an approach that works for you?
It's a combination. I think every day our firm sees 5 to 10 deals. And of those 5 to 10, there's 1 to 2 that our firm thinks is interesting. And it takes 50 Bs to recognize an A. And, we have so many Bs that we've seen that when you see an A, you can recognize it. And there's so much deal volume that have come across our desk that you build a frame of reference and you learn things. I mean, when we get pitched a company, it's amazing. You're talking to somebody who is an expert at one thing and they're just gushing their like life's work to you. All this work they've done for 5, 10, 2, 3 years to come up with 30 to 60 minutes of the most important information they've ever come up with. And you get to listen to it and learn from it. Oh my God. Like I joke because I have to pitch our fund sometimes. And when you're pitching a company, if somebody doesn't like your company, like you're like, okay, like all right, they don't like my idea. When you're pitching your fund and they don't like your fund, they're like, no, we invest in funds, it's just you. So it's kind of like a personal rejection. And even worse is like, you'll do this call and for me, it's like, here's my life's work, is everything I've ever worked on. And somebody's across the table and after like 45 minutes, like, huh, okay. You're like, what? That's all I have. And so, when we talk to a founder, we're like, oh my God, this is their life's work in 45 minutes. And you do so many of those that you learn so much about different parts of the market. And And also, I think one of the learnings is by being in 3 different markets, you can see things in 3D. Like you have perspective on how would a venture capitalist look at this company? How would someone look from a structured credit or a structured equity perspective look at this company? And so it's just the deal volume, I think, really builds a frame of reference, and you're constantly learning about markets. We've invested in 150 companies or more. I'm sure it's more. We, my friend Jesse at IA, he and I joke we're like gamer friends, like, and our email is our console, and so you just constantly talking with your friends about what they're seeing, and then also you just see shit. I've seen companies go public on good exchanges and bad exchanges. I've seen founder breakups. I've seen enough pay to play rounds to know that not all are the same. I've seen how different investors react. I've seen a VC that we would all know go on and blog about something, and it's just a lot of it is just the volume of stuff that you see, and just being obsessed with it.
Yeah. Amazing. Well, Ali, I think people will be taking a lot of notes about this conversation, about your learnings. So thanks for doing this.
Thank you for having me. I appreciate it.
Of course.
The Fintech Leaders podcast is for informational purposes only and should not be considered financial or investment advice.